Okay, it's Jack from Jack 8, the Real Estate and the Online Real Estate Academy. We have some Fed talk out today. Jay Powell is talking. Just finished recently talking. Let's cut and about the 10-year could go back to 5.5%. We have some video I want to show you on that, which would equate right now. The spread is about 285 points. So that would equate to mortgage rates of 8.35 approximately. So let's see if we can cut to CNBC, and then we'll look at that projection for rates to go back up and talk about how that actually would happen. But let's cut to CNBC at the moment.
Pricing in the cut.
Yeah,
maybe that'll change in the coming weeks.
Trying to inject any real suspense
Powell,
into
premature.
the December meeting.
Too soon to speculate.
I'm reminded of
in
September after the Fed meeting there in his press conference. He was asked about the neutral
like
rate
and
how is
cold
the
water
Fed funds rate relative to the neutral rate. Does that tell you that we're more or less restrictive? And he kept going back to that line of, we don't really know what the neutral rate is. We know the neutral rate by its works, which means we know how the economy responds. We can look at the data about how the economy responds. We're not going to necessarily be governed by some, textbook or theoretical definition of how restrictive we are. The 2-year note yield, it's around 465. It has been lower on this trip. So we did get a little bit of a bounce off these comments.
And again, the headline here is Fed Chair Powell calls talks of cutting rates premature and says more hikes could happen.
Going to do that, right? They have to preserve some sort of optionality in case inflation flares back up or doesn't come back down as promised. But I do think by them saying we haven't fully seen the effects of the tightening, and
they're committed to the 2% rate, which we're not near yet.
Sure.
They've done a lot of the work.
Proceed carefully has been the mantra.
Proceed carefully. I don't think that changes up the script here. For some reaction and a look at the markets heading into 2024, let's bring in BMO Wealth Management CIO Youngyu Ma. Young, your first take, Youngyu, on the comments that we're getting from Chair Powell?
Yeah, great to be here, Sarah. More or less as expected. We did think there would be some pushback on the idea of what the markets are pricing and now a little bit more aggressiveness or optimism.
So what he just said is that this was as expected because the markets were maybe a little bit more optimistic than they should have. The markets were kind of treating it as if we were already at 2%. Which we're not. We're well into the threes for inflation.
70s, really front and center, which Chairman Powell has talked about many times when the Fed really eased up or took their foot off the brakes too soon and inflation made a resurgence. So I think the Fed is really in it for the long game, and the market is a bit too optimistic in terms of pricing and rate cuts earlier in the year next year.
You're making my case.
Why do you think the market's too optimistic?
Well, I think that's
just because Powell is saying too soon to speculate on when to lower rates. That's never stopped the market before. It's not too soon to speculate,
but we think the Fed will stick to these levels for quite some time, and it's probably more of a summer or perhaps second half story when rates start getting cut. But that said, let's take
just in time for the election.
Probably still more important than the actual timing. Whether it happens in the late spring. In the summer, as long as that trajectory is in place, as long as inflation keeps falling, and as long as growth stays stable, I think the markets are still in a good place here.
Yeah, I mean, the debate would seem to be around, whether if the economy remains resilient, whether they're going to be talking about so-called fine-tuning or insurance cuts.
Which would basically mean no recession. So there's an argument now that there might not be a recession. So this is the big battle, right? Well, are we going to have a recession? We are seeing some slowdowns in a lot of indicators, but it's slow in coming.
Yeah, I think that's a good point, and that's what we are expecting. And as was mentioned previously, a lot of factors are coming into place for the economy to look relatively stable, perhaps have some softness in the coming months. But what does the Fed do in the face of a stable economy? I think the answer is it probably keeps rates higher for longer to make sure inflation comes down to that 2% level.
So now we're going back to that narrative.
Sort of more eager about cutting rates. So we do think that the elements are in place for a stable economy going forward. We're expecting a soft landing, and that is the big question mark of how the Fed responds to that.
So more comments from Powell here, just some headlines. Job market has cooled, but is still strong. He's obviously welcoming the recent softening in inflation data. We are going to get a jobs report next week. Do you
Week from today.
continue? Do you expect that we'll continue to see the job market cooling, and at what pace here?
I do think there are continued indicators that the job market is cooling. But that said, it's cooling to a more balanced level. It's not going from balanced to weak. It's going from relatively strong to more balanced now. And I think the big data point that we're focusing on to sort of tip the scales, if that were to happen, are the weekly initial unemployment claims. If those start to spike up, then I think we could go from balance to weak. But right now, those claims remain on a weekly basis at rock bottom levels. And so we expect the jobs report, to show some softness, but still kind of hang in there, probably create, somewhere between 150,000 jobs, which is more or less.
Remember, the Fed's strategy is effectively to recreate a recession to kill inflation. And this guy here is effectively saying, maybe we're going to have to live with inflation, which would mean higher rates.
He's not leaning one way or the other necessarily. I mean, I think he's
certainly not going to indicate whether he's leaning one way or the other.
Yeah. The other option, of course, is the worst of all cases, which is higher rates and a slow economy. Oh, man, that's called stagflation. Don't want that.
Where they think they need to go ultimately, plus probably some disagreement on that committee. I mean, let's be honest, as we get into further meetings, there's probably going to be a little bit of a push pull.
No, on what? On when to cut?
I think on when to cut, on when to try to anticipate weakness, and whether in fact you want to obey whatever rule you think is you should based on Fed funds versus neutral rate or inflation.
I mean, Young-Yu, it's hard because they want to preserve a soft landing.
10-year now,
but they also want to make sure that inflation is going all the way back down to target. So when will they know when they can cut?
And once again, once you take the 10-year number, which is at 4.3, you add about 285 basis points, and that's going to approximately get you your mortgage rate, 30-year fixed with good credit.
Cut rates before the economy slows too much, or before inflation may be all the way back down to target. So I think the Fed is trying to anticipate the movements of the economy and the labor market. But again, let's go back to the Fed's job description. The Fed's job description is a dual mandate of maximum employment and price stability. And as long as the Fed thinks the maximum employment box is checked and we're not seeing undue weakness in the labor market, it's probably going to still focus on price stability and bringing the lagging inflation numbers, not just the leading indicators, but the lagging inflation numbers back down to 2%.
By the way, if you want to type in your
labor
comment
market
here,
remains healthy. So I think that's what the Fed is going to key off of, really looking for signs of labor market weakness before it thinks about cutting rates.
Right. Although the market can't be expected to just kind of wait and not try to anticipate, right? Because inflation at the moment.
See, to me, this is just kind of a ridiculous discussion. Just if I can just quickly interrupt, because to think that this one person or a group of really people, elite people in Washington can have like their hands on the dials of the economy and try to predict what is going to happen based upon effectively lagging indicators. As Powell himself described in Wyoming earlier this year, he's navigating by the stars under a cloudy sky. It would be, when we talk about the Fed's job description, a lot of people out there, you've heard me say this before, they think that, they could do a much better job. I ask, why are they doing the job at all? I would rather the market set the rates. The market set the rate. I know that's a radical idea, but that way we don't have a bunch of people in Washington trying to like look into some like Ouija board situation to try to figure out whether the market's going to go up, whether the economy is going to be good or bad. We actually just let the market react with its infinite number of decisions, and we set rates that way. That sounds a lot better to me.
To help talk us through some of these breaking comments from Fed Chair Powell. And I just want to give you a quick market check here, show you what's happening, which is not a lot. You know, the Dow and the Dow's been swinging from gains and losses. The S&P 500 is showing some strength in some of the cyclical.
All right. So what I want to do now here is bring you up this bond trader, bond analyst. I know your eyes are glazing over. I get it. But listen to what he has to say here Let's bring it up here from yesterday on CNBC.
Rebound ahead in the benchmark 10-year yield. Market forecaster Jim Bianco runs Bianco Research. Jim, great to have you with us. We were just saying how maybe it's all about rates. And if that's the case, then this is bad news for investors who are bullish, who are long. You're saying 5.5% is where we're headed on the 10-year.
And again, that would mean mortgage rates in the low 8s.
Yeah, I was on with you a month ago and I said, the 10-year's going to 5.5%, and it's been a terrible month for that call. But
that was also basically my call. That's why I'm bringing this guy up here, because basically I'm kind of agreeing with this guy from a different perspective. But yes,
still there at 5.5%, say in the first half of 24. And the reason is I don't think we're going to have a recession, and I think that the inflation rate is bottoming somewhere around 3%. So if you've got 2-ish to 3-ish growth in the economy.
And that might be a very interesting perception. We might have the Fed say they want to get to 2%, but there might be kind of like a quiet quit from the Fed, and they'd be like, oh, sure, we want 2%, but they settle for 3%, which, or it's low 3s, which that could definitely happen, right?
Which is what it's been for the last 5 quarters and projected to be in the current quarter. And say 3 on inflation, that's 6% nominal growth. I put a little fudge factor in there, and I got 5.5% on the 10-year note, because the 10-year yield should somewhat approximate where nominal growth is.
The 10-year yield should approximate nominal growth. That's an important concept.
So that means that the economy, interest rates should probably bottom out here in the next month or so and continue to move higher. What does it mean for stocks? I heard you guys talking about this earlier. I think the biggest problem stocks have now is there is an alternative. There is an alternative in 5.5 to 5.25 money market funds. Dr. Jeremy Siegel just finished a new edition of his book, Stocks for the Long Run. And he says over the long run, the stock market should, over many, many years, give you an 8% return. Well, if I could get 5.5 or so in a money market fund, I'm getting 2/3 of that with no risk.
Assuming the U.S. doesn't default. Let's hear about why you could go stretch for 8, depends upon how patient you are. But if I can get 5.5 with theoretically no risk, meaning, my company doesn't go bankrupt, because they pay the bonds, why do that? Now, some people will stretch it, right? Some people will want that 8% yield, but there's a lot of smart people like 5.5 safety. That's a good play.
So the stock market's really got to do something better than average to get people interested. And all we've seen it do so far this year is get people interested in AI, because if you take the AI stocks out of the S&P or the S&P 493, they're collectively up 3.5% this year, or less than cash. And I think it's not because the economy's bad. I think it's because the competition of higher rates is a problem. So if rates move up in the first half of 24, that hurdle is going to be bigger for the stock market.
Is a backdrop to your call.
And he hasn't even gotten to the point of that is my main point, is that we have this massive amount of government debt that's going to be coming on that is going to drive up the 10-year. By the way, we haven't covered this on this channel, but we recently had a 7-year auction, which went very badly. You might remember we had a 10-year auction about 2 weeks ago or something that was blamed. It went badly, and it was blamed on some type of cyber attack at a Chinese bank or something like that. We've now had a 7-year auction and a 2-year auction, neither of which went well, and there was no subsequent cyber attack blamed for those.
For rates to go to 5.5%, that the Fed is done, Jim, and rates go higher anyway?
Yeah, I think the Fed is at least done. I don't think that they're going to be cutting rates. I'll point out that it's been almost 35 years since the Fed has cut rates with core inflation above 3.5%, and we're at 4% right now. So unless there's a serious deceleration in core, I don't think they're going to cut rates at these levels. And I wouldn't be surprised if there's talk in the first half of 24 of one more rate hike, just one more. But that's just one more. But I'm really more
25.
emphatic about the idea that I think that all the rate cut talk is a little bit premature. The idea behind that is interest rates,
and based upon what Powell just said, that seems to be a really good call looking at it now, because Powell basically just said rate cut talk which has been hot on Wall Street because Wall Street wants that cheap money. Whilst it's been really hot.
Back on.
Thank you. Good to be here, particularly on National Peppermint Bark Day. I found out.
National Peppermint Bark. Yeah, I saw
bark.
William Sonoma handing it out. It's the holidays here at the New York
Does
Stock
anybody know
Exchange.
when National Direct Lending Day is?
It's Peppermint Bark Day. Oh, peppermint bark. Oh, my pre-diabetes self wants some.
On landscape.
The overall market for direct lending is really good today. Right. At the end of the day,
so they are off Powell at this moment. So that is the update right now. I know this is contrarian thinking, and I don't want to be right. Let me be perfectly clear. I'd be happy to be wrong, but I'm not. And at least I don't think so. And I'd be happy to see rates slide down to 6.5 or something, 5.9, right? Happy to be wrong about this, but I don't think I am. So if you're a buyer now and you're saying, 7.1 is too high, and rates have peaked, they came down pretty quickly. The peak was October 18th, if I remember correctly. And now we're December 1st today. So they came down pretty quickly. They could go back up just as quickly. And I think there's a lot of pressure moving in that direction. Happy to be wrong, but again, don't think I am. All right. Hey, thanks so much for joining us. This has been a lot of fun. Really enjoyed today's thing. We have one comment, though. Jeffrey is taking issue. He doesn't agree. 8% highly unlikely. JP already said he is done hiking. Yeah, well, also, though, remember, Jeff, that and I'm so glad you commented. Thank you very much. Thank you for commenting. Remember, Jeff, of course, that the 10-year can travel independently from the Fed number. Those don't always track together because there's one giant other lever on the 10-year, which is not what Powell says, but what Congress does in their spending. And we already have known from Yellen that the Treasury plans a massive increase in the amount of money that they have to borrow. So there can be a divergence, and there has been in the past, between the 10-year and what Powell says. Everyone focuses on Powell as if he's the only factor. And he's an important factor, don't get me wrong, but he's not the only factor here in what rates do. The economy, Congress, Powell, it's kind of like a threesome, so to speak. So great comment. I'm so glad you commented, Jeff. Thank you so much. I don't think I've heard your comment before. In the meantime, this has been great. We'll be back with you. I think I have another video coming up today. I don't know if we'll be live, just might post it, but we'll talk soon. Thanks so much. Have a great day. Go make some money.